Now joins in, MD and CIO of Quantum Advisors. Subramaniam, good morning. It's been a very volatile market at index level, but stocks have done well. Would you expect this kind of trend to continue?
I would expect this kind of trend to continue. There are a number of global reasons why the markets could be nervous, including the increase in interest rates in the Western world. There could be some pull-off or pullback by the FIIs. Given the fact that recently the stock performance has been weak, it's quite possible that Indians who have been investing in large numbers over the past 1 year, they may also redeem, and therefore you could have some sell-off coming in because of disappointment. That is one. Then corporate earnings numbers have been a little muted till now. Everything is being pushed back. Last year it was expected that things would improve substantially by the middle of this year. That hasn't really happened. So there are enough reasons for the market to feel nervous, and given the fact that valuations are not extremely cheap yet, one could expect the volatility could continue for some more time.
Okay. Subramaniam, hi, good to see you in today. How would you approach a couple of these commodity plays now? Say, for example, Ken, which is directly linked to crude prices, and that's obviously fallen overnight, and NYMEX is at 7-year lows. Even say something like a Vedanta, Hindalco, which are directly linked to the global commodity cycle. Is it a good time to maybe nibble based on valuations, or is it a complete stay away?
No, so without going into specifics of any company, in general, commodities look cheap, but the question to ask is really what are the triggers? Why should these stocks move up? And there it looks like the triggers are still some time away. So there's no hurry for people to get into these kind of stocks. Again, when I say it looks cheap based on some long-term fundamentals, long-term pricing of the products which they sell. And if the products which they sell continue to see very low to declining prices, then the trigger for these companies to really, turn around could be quite some time away. And that's one of the reasons why, it may not be a good idea to invest right now. Although you know that there is value at this point, and it may help to buy some. But given the fact that there are no triggers immediately for these kind of stocks, I would wait before buying into these companies.
Okay, what would be on top of your buy list, Subra, after the kind of correction that we have seen?
See, we are very positive on consumer discretionary, on banking in general, although private banks look expensive. We like the tech space. We like all the PSUs in the energy sector. They also look attractively priced. What we don't like currently still continues to be the pharma, the FMCG consumer staples, and to some extent even cement companies. They look to us a little expensive. And given that private capex isn't yet picking up, and public capex may not really drive the demand for cement to a very large extent, the stocks look expensive. But otherwise, the rest of the sectors, we are quite happy holding on to the companies which we own.
Okay. And the perennial question between private and public banks?
We like both, but in public you have got to be very choosy. Not all banks manage their asset quality well. So we are comfortable with maybe 1 or 2 banks, not all the banks. Even though the valuations look expensive, we are just not comfortable with the asset quality. But in 1 or 2 banks, the asset quality may be weak, but at the same time, we know that the management is doing a lot of things which will improve the asset quality going forward. And given the attractive valuations, one could take that risk in investing in them. Private sector we like, but again, they are not cheap. Many of them are like, 3.5, 4 times price to book. So it's a wait and watch. We will, if it comes to our buy limit, we will buy. Otherwise, we will let go of that opportunity.
Okay, what about large cap IT and pharma names, Subra? Because that was one space where at least there was, people could hide in that, in those 2 sectors. But even they have started to underperform now.
No, did you say IT and pharma?
Yes, IT and large cap pharma.
Yeah, so the IT, I think, the business opportunities still look good. Currency depreciation may help, but really you are not buying these companies for currency movements. Many of the large companies still have huge potential to grow. The business models are proven. So I don't see any reason why I should be worried about near-term underperformance. So if they underperform, if the stocks come off, we would be more than happy to buy some more into these large companies. Because anywhere you look, whether it's in the Western world or within India and emerging markets, the trend towards spending on IT is only increasing. Some countries do it a lot more than others, but you do find that every company, every country wants to be competitive, and therefore spend on IT is necessary, and Indian companies are well placed to tap into that opportunity. So we are positive. If it declines, the valuations will only look better, and there is no balance sheet risk in many of these large IT names. Pharma is a different ball game. We were not comfortable with the valuations, and of course some of them have come off because of regulatory risks, but the risks have not gone away. So unless you have a convincing method to analyze and say, okay, if these risks emanate, these companies will be able to address that, then one could go ahead and invest. We haven't yet found a company where we get that kind of conviction, so we are still staying away from investing in the pharma.
Okay, fair enough. Subramaniam, we're going to leave it on that note. Thanks very much for joining in and talking to us. Well, that's the update coming in on the markets, but let's talk about the biggest loser in trade yesterday. That was ITC. To